Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, May 31st, 2024. First, the good news. Last week, the S&P 500 index hit a new all-time high. That was partly due to the strong performance of NVIDIA, which released strong quarterly results that pushed its share price nearly 10% higher that day. NVIDIA is now the third most valuable publicly traded company in the world, so its performance has an outsized influence on the market cap-weighted S&P 500 index. So here's a chart of NVIDIA year to date. You can see over the first 2 months or so of this year it was on a steady rise, but then it leveled off March, April, and even first 2 or 3 weeks of May. But you come out here to May 22nd, the day that NVIDIA's results became known, and look at that. It just shot up from a little below $950 a share to almost $1,150 a share just a few days later. So that's good news for NVIDIA shareholders, and it's also good news for index investors who are tracking the S&P 500 index. But now the bad news. The performance of the S&P 500 index is misleading. On an equal weight basis, the index is well below the all-time high it hit 2 months ago. Its most recent decline began 8 days ago on the same day that NVIDIA made its big jump. Through yesterday's close, the Invesco S&P 500 equal weight ETF was up 4.1% this year, compared to a 10.9% gain by the SPDR S&P 500 ETF Trust. So here's a chart of the Invesco equal weight ETF, and by that it means all 500 holdings in the S&P 500 are treated equally in terms of measuring its performance. You can see here it peaked actually on the last trading day of March, on March 28th, and it dropped in April, then rallied here through the first half of May. But again, we come out to May 22nd and it starts to drop. So May 22nd has really been the pivotal day for a lot of these things. Now, that big of a divergence in recent performance suggests that Wall Street is back in a risk-off mode. If so, then that would explain a spike in the CBOE Volatility Index, or Fear Index, during the past week. So I'm going to show you that chart now. This is a year-to-date chart. On May 24th, the VIX closed at its lowest level in over a year. And here is that day right here. And again, that's 2 days after NVIDIA released its results. But since then, it has risen by 20% as professional portfolio managers have purchased put options on the S&P 500 index to hedge against a possible stock market correction. So that's the big jump you see here. Of course, a rising VIX does not mean that a stock market correction will occur. In fact, now I'm going to go back and show you the VIX for the past year because I want to make a point. You see this big spike over here? This is second, third week of October. And the VIX is over 20, which is considered a great big red flag that a stock market correction may be imminent. However, the fact of the matter is the VIX was recording these very high levels shortly before the stock market began to rally. If anything, the VIX tends to reflect what just occurred instead of predicting what is about to happen. As for what is about to happen, the next meeting of the Federal Open Market Committee is June 11th and 12th, at which time the FOMC will discuss its monetary policy decisions. My guess is they won't make any changes given this morning's Personal Consumption Expenditures Price Index report for April. So I'm going to show you that. And here's the report. Last month, the CPE price index, excluding food and energy, rose 2.8% over the previous 12 months, far above the Fed's target rate of 2%. So if you go over here to the far right-hand column, that's the month of April, come down here to the indexes. The PCE, including food and energy, rose 2.7% over the previous 12 months. Excluding food and energy was up 2.8%. Now that's far above the Fed's target rate, again, of 2%. That is the same number recorded for February and March. So if you look here at this 2.8% in the bottom right corner, and then you come left into March and left again into February, it's been stuck at 2.8% now for 3 straight months. So there's no reason for the Fed to start cutting interest rates now, especially since disposable personal income rose 0.2% in April, matching the 0.2% rise in the PCE price index. So you can see here, when you look again under the column of April and you look at PCE, these are the monthly numbers now. Excluding food and energy was up 0.2%. So in other words, disposable income and inflation rose at the same level in April. So despite the Fed's raising interest rates, consumers still have enough disposable income to be able to keep spending at their current levels. For all those reasons, I'm not expecting the stock market to break out of its current trading range anytime soon. This morning, the S&P 500 index opened at 5,243, which is precisely where it was 2 months ago. I would not be surprised if it was trading at that level 2 months from now. So here's the S&P 500 index. We look at the past year, and overall it's been great. We look, say, year to date, and if I drew a line, excuse me, well, that's the SPY, but it mimics the index. So if we drew a line over here, guess what? It's slightly below its highs from 2 months ago. So we've actually been in a trading range. We may stay in one for most of the summer. That's not a big deal. Stock market doesn't always go up. Just look at this chart here over the past year. Yeah, it's been a nice gain, but you can also see there was a several month period here, basically from July through the end of October when it was on the downswing. We just went through a period here of March all the way through basically early May. So I'm expecting the market to stay in its trading range until we get more clarity about the Fed and interest rates. So that's this week's PF weekly update. I look forward to talking to you in another week. Thank you.